The first main topic is quantitative methods: interest rates, present value, and future cash flow. In this video, I aim to dive into the very basic calculations and the common fundamental concepts of the CFA Level 1. It refers to understanding the rates, present value, and future cash flow. So, as the main goal of the CFA Institute is to prepare professionals in the field of investment analysis, that means much of the work involves evaluating transactions with present and future cash flows. When we attempt to evaluate the value of any asset, for example, the value of a security, we are trying to determine the worth of a stream of future cash flows, which will help us execute all necessary tasks. The first step to achieving this is to understand the mathematics of time value of money problems, meaning that money has both current and future values. The basic concept is that a given amount of money is more valuable when received earlier due to opportunity cost. For example, deposits in banks may be used to earn interest rates proposed by the bank, resulting in a higher return. Therefore, a smaller amount today may be equivalent in value to a larger amount received at a future date. This concept is essential for investment analysis. Let's discuss interest rates. The CFA exam often tests a particular value for the interests, which is already given, and we need to calculate with the given interest rate the value of a particular amount in the future. Alternatively, we may be given the future amount and interest rate, and we need to calculate the present value of the given future amount. Let's consider a simple example. If you pay $9,500 today and will receive $10,000 in the future, for example, in 1 year, can those amounts be considered equal? In some cases, yes. Or can the $10,000 be considered even less valuable than $9,500 today? In some cases, also yes. For example, if you can deposit your $9,500 in a bank and receive more than $10,000 for a particular period of time. But, for example, let's assume that you are content to receive $10,000 United States dollars in 1 year if you put in $9,500 today. An interest rate denoted in the CFA exam as R is a rate of return that reflects the relationship between differently dated cash flows. In this example, the difference is $500, so we can easily calculate the interest rate for this compensation of holding our $9,000 for 1 year. Let's simply take $500 and divide it by our initial amount invested, $9,500. We will get 0.0526 or 5.26%. Interest rates can be viewed in 3 ways. First, they can be considered at the required rate of return. That is the minimum rate of return an investor might receive to accept the investment. Second, interest rates can be considered as discount rates. In the previous example, 5.26% is the rate at which we discounted the $10,000 future amount to find its value today. Thus, we can use the terms interest rate and discount rate almost interchangeably. Third, interest rates can be considered as opportunity costs. An opportunity cost is the value that investors forgo by choosing a particular course of action. In this example, if the party who supplied $9,500 had decided to spend it today, they would have foregone 5.26% on the money. In this case, we can view 5.26% as the opportunity cost of current consumption. One of the fundamental rules tested in some forms in the exam is the fundamental understanding of the economic meaning of the interest rates and how they are constructed. This is very crucial. The interest rate is composed of a real risk-free interest rate plus a set of 4 premiums that are required turns on compensation for bearing distinct types of risk. As previously mentioned, R is our interest rate, is equal to the real risk-free interest rate, for example, treasury bills or central bank rate, plus inflation premium, plus defaults risk premium, plus liquidity premium, plus maturity premium. Understanding each component of this interest rate is crucial, so please pay attention to this. It will recur throughout the curriculum. You can explore all these elements provided by the CFA curriculum. On the next video, we will discuss the future value of a single cash flow, and we will dive into with some more calculations. Thank you.